Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Well, welcome to another edition of Something More with Chris Boyd. My name is Jeff Perry, and I have the privilege of sitting in for Chris Boyd today. And in studio with us, we have Brian Regan. Welcome to the show again, Brian.
Hi, how you doing, Jeff?
I'm doing great. For those of our listeners who don't know Brian, we have him on as our expert in all things market and economy. Brian is our senior portfolio manager with the AMR team at Wealth Enhancement Group. And Brian, we are talking today about whatever is on, I almost said everyone's, it's probably not everyone's, but most people's minds as the election is fast approaching. And so it's dominating our news cycle. It's dominating our advertisements. If you live in a swing state, you're getting bombarded with advertising. If you're living in a red or blue state, maybe a little bit less. But either way, it's first story on the news every night. It's all over our internet. And it's also on the minds of our clients, investors. And so that means it's on our minds as well, because when we have a client call or someone comes in with a question, almost all these conversations start with something about the election. So here we are. Brian, I want to get your perspective on, I guess we can start with how much does it, we covered this before, but let's start with something. How much does this really matter? Who's in the White House?
Yeah, it's a great introduction, Jeff, and I'm going to do my best to be as neutral as possible, but I'm going to stick with the facts, and sometimes the facts are going to upset people on the left, and sometimes the facts are going to upset people on the right.
It's a famous quote.
So I am, I'm at risk here of alienating a whole lot of people. I'm completely understanding of that. I'm prefacing this by, I'm not trying to influence anybody here. I'm just trying to tell you what I think is going to happen. And I'll get into what I think are the drivers there, the assumptions behind, how the capital markets will be affected by certain policies. And hopefully, if you disagree with those assumptions, fine. Like that I'm going to come with a base set of assumptions where I'm going to make my decisions from. They're not political; they're strictly economic.
Right.
And you might disagree with the politics of the policies, but that's not necessarily what I'm talking about. So I think it's important to get that out of the way so we can have a sober conversation around political policy.
I hope we can. I know we can, but I hope our listeners can understand that, I joked facts are dangerous things, but that's what you're here for, to give us your perspective. You're our expert on the markets and the economy and how different things impact those investments. But whatever your opinion is politically out there, just remember to vote. Don't sit it out. Don't not vote because maybe you're in the majority of people who don't like either one of these candidates. But get out there and pick the candidate that you think is most in line with your values, your issues, your investments, whatever is really most important to you. Because if you sit on the sidelines, you really kind of forfeit your right to complain about the results later.
So I think this is all an interesting preamble to the worst chart I've ever seen in economics. So This is a chart I have from JP Morgan. It will be in our quarterly investment deck that we will be doing on October 28th. I believe it's October 28th. It might be subject to change for clients. So if you're a client, you'll probably be seeing this chart. If not, you could probably Google it it's a chart from JP Morgan's Guide to the Markets. And what it shows is how people feel about economic conditions, whether it's good or bad. And what you can see is that it's heavily, heavily, heavily influenced by who's in the White House. This is
You mean by, like, if you are a Democrat and you have a Democrat in the White House, or vice versa, if your party is in the White House, you feel better about the economy? And
if your party's in the White House, you think things are great. If your
Mhm.
party's not in the White House, you think things are bad.
Yeah, I hear
And
that. I hear that from people.
it moves on a dime on the chart. So
Mm,
it's that's why I call it the saddest part. People do struggle to have this conversation in a sober, normal manner. Now, the second chart that I'm going to show on the election in our quarterly investments kind of debunks, kind of shows the story on why this is kind of a silly way to think, right? And you can see that it shows stock market returns by president. Almost all the
right.
lines are positive and very, very positive, regardless of who is in the White House, whether it's a blue president or a red president. The chart goes from Eisenhower all the way to Biden through the summer, and we know things have only been good since the summer of 2024 here. But if you sat out the returns during the Trump administration, you missed out on a near 70% return. If you similar story. If you sat out
Right.
Biden years, the Obama years were overwhelmingly good. The Clinton years were overwhelmingly good. Bush Senior, very good. Reagan 1 and 2, very good. I mean, you can go back and back and back. The only one that's really negative is the second George W. Bush. And let's remember that
Mm,
bad luck and good luck play into this. So that's why we discount this to a certain degree. And this is a man that came into office and had 9/11,
right.
9 months after inauguration, and on the latter half of his tenure, he had the great financial crisis. So
Right.
I think if you look at this chart and you say, hey, look, this is evidence that the Republicans are worse, I'll counter with, hey, look, bad luck happens, and there's a lot of people at fault for what happened in the great financial crisis and 9/11, both Democrat and Republican. So
Let's go
I'll leave
back.
that at that.
Let's go back to the first thing that you covered. The first chart that you mentioned about the sentiment, if you will, the opinion of the economy, because we're definitely seeing that in the political advertisements. Republicans are presenting that the economy is in shambles, right? And the Democrats are running that it's a strong economy. And I, I get that if your team isn't in the White House, that you're going to feel maybe less confident because you have more confidence in your team. But the economic data currently, as we speak, is pretty darn good and has been for a while. If you're just looking at the broad things, I mean, you look at everything I know, and you look at things that many investors haven't even, many of our listeners haven't even heard about. But if you're just looking at, like, is the inflation rate under control? What's the job market look like? What's the status of interest rates? Things, that affect every person in the country. You want a job, you don't want to have runaway inflation. It feels like things are pretty good, and the stock market has, which is a reflection of how things are and how things look, has, as you indicated, has been doing great. So that is shocking to me. And you saying that's chart is shocking. It is, because it just doesn't match up at all.
Yeah, I mean, I'll just tell you what the chart says. It says that 10% of Republicans think the economy is in good shape right now. And what you just said is flies in the face of all of that. And generally speaking, I agree with you. Inflation's under control. The unemployment rate is historically very low. It is rising, so that's something to consider.
Right.
This a lot a lot of this can be summed up right now in politics. I mean, I think 90% of it is, and I think the other 10% could be summed up in inflation. People really, really hate inflation. When you get a raise, it's looked at as because of your merit, and when prices go up, it's looked at as somebody else's fault. And the reality is that sometimes they go hand in hand. You can get increases in wages across the country, and that will naturally cause inflation to go higher. But that's just not how it's viewed. Even if sometimes
Hmm.
it's the reality, the level of prices is definitely higher than it was pre pandemic, right? Prices haven't gone down. They have for certain categories. They actually are coming down for certain categories, but
Right.
across the board, that's not the way it works, right? Inflation continues to rise, and it continues to rise, more slowly. So, I think a lot of that is especially right now based on how close we are to an election, a very close election, very, as you said, very polarized and
Hmm.
advertised election. People are going to be influenced one way or another, not necessarily based on the facts, but based on their political leanings and emotions.
Do you think it's influenced at all, staying on the topic of inflation, because we had such a spike. I mean, inflation goes up and down, and we did have a long period of very stable, low inflation. So people got accustomed to not feeling price increases, even though they were there, slowly increasing. But because we had such a spike in a relatively short term, that people really felt that impact, and it's still.
Yeah, I mean, absolutely. That's what it is, right?
Mhm.
That's that extra 10%. I mean, I really think 90% of it. If Trump wins, you'll see that number goes from 10% to 75%. So it's all, a lot of it is just political, like I mentioned. But I do think there is this feeling of prices are higher.
Mhm.
At the same time, wealth is up $50 trillion since the beginning of
Mhm.
the pandemic, right? People are, on average, much, much wealthier. Wages have caught up. Real wages exceed pre-pandemic levels. So, there might be that feeling, but it flies in the face of the reality that people, if you own stocks, if you own a house, you're doing much better off. If you have cash that's generating money market fund, you used to get zero, now you're getting 4.75%. People are generally better off. You've gotten COLA adjustments on Social Security,
Mhm.
and now gas prices are going down. So you can make the argument that you are, objectively better from a Social Security standpoint than you were, uh, pre-pandemic. So, I guess generally speaking, there's a lot to be optimistic about as well. But it just doesn't pull that way. And I think this is something to consider when you look at any survey data. We're talking consumer confidence, we're talking PMIs. People put a lot of stock into this, and I think if you spend some time looking into the response results, and like how many people actually respond when they're reached out to,
Right.
how they reach out to people, you can see that there's a lot of flaws. How they ask the questions, you can see that there's a lot of flaws in this type of analysis, and you should discount certain data points for that reason.
It is. I was looking at some polling before we jumped on our podcast today, and the Gallup poll that came out a couple days ago still has the economy as number one, the most important issue to voters. Just for sake of reference, number two, I'll just give you the top five. The economy is number one. Number two is democracy in the United States. Number three is terrorism, national security. Number four, which I found a little surprising because it's not talked about much in the media right now, but it's the types of Supreme Court justices candidates would pick, and number five is immigration.
Hey, look, that's an interesting list.
It
I can
is.
say that, but I don't have much to comment on it.
Mhm.
Those, I think those issues are kind of personal to everybody, and I'm
Sure.
not familiar with the survey, but it seems to line up with what the candidates are talking about, at least.
Yeah. Well, the economy is still number one, and going off these comments that we're talking about is how people feel is versus the actual data that's out there. Let's shift that kind of sentiment, and I wanted to ask you a question about the stock market generally. I hear a lot on the commentators on the financial talk shows, CNBC and so forth, about we're definitely in a bull market, right? It's growing, depending on when people listen to this when it airs, but near record highs recently, certainly in October here. Um, but there's a sentiment, at least from the people that I'm listening to, that many investors don't believe in this bull market, meaning they don't have confidence in it. They're nervous about it. Is that something that you see that other people have? And do you agree that you're nervous about the levels here that we're at?
There should be a giant disclaimer whenever you watch those financial shows that negativity sells. So
True.
it's
That's
pretty
there should
remarkable
be.
where we've had back-to-back years, calendar years here, where stock market's north of the S&P 500 is north of 20%, and
Hmm.
people say that they don't have confidence or this and that and the other thing. Negativity sells, and people have an agenda. So if negativity sells and they're selling something,
Right.
they might be prone to be negative. I I would just say that we just talked about a bunch of things that are things to like in the economy right now, and I would have to think that there would have to be some kind of radical external shock to kind of throw us off the very positive course that we're on right now. And why do I say that? Mostly because the earnings expectations are very, very good. And as long as earnings expectations are very, very good, you're going to have a stock market that's going to continue to march forward, because earnings will continue to march forward, and as earnings keep getting better, it follows suit. There's no lid, as I say, to this glass. The glass can keep getting bigger and bigger as it has over time. But I actually wrote a note to a client this morning who was like, what do you expect in the next quarter? And I tell this gentleman time and time again, I don't prognosticate on what I expect over the next quarter, but he still asks. It's almost like he thinks he's going to catch me in some kind of trap. But I can't comment on things I don't know, and I refuse to. But some things, I put down here. If we had an inflation resurgence from deficit spending, loss of Fed independence, or tariff wars, we saw in 2022 what increased inflation can do to an economy and interest rates. That I think when it comes to policy, and we can get more in depth into specific policies for each candidate. I think those are real things to keep in the back of your mind. I don't think you should be prioritizing them right now, especially since nobody's been elected, whether in the congressional circles or in the executive branch. So, you take a lot of this with a big grain of salt, right? Geopolitical events, it's no secret we have a big issue continuing in the Middle East.
Correct. Yeah.
Israel started going after Hamas in the Gaza Strip, later in the West Bank, and now they're going after Hezbollah in Lebanon. These are all Iranian-backed terrorist organizations. And Iran responded by launching an unprecedented amount of rockets at Israel, which, thank God, I believe they were all shot down. But this is obviously a problem, particularly when you think about the Strait of Hormuz, which a lot of oil throughout the world flows through. If that gets shut down for one reason or another, you could have some kind of oil spike, albeit probably temporary, right? Because it could probably just be rerouted around the south end of Africa. But Israel could go after oil infrastructure, for example. All these things are possible. Now, this is less of an issue than it was in the 70s, because the United States is energy independent. So it's just less of an issue, but it's definitely something to pay attention to. And I think this is part of the reason why the markets is, kind of get comfortable with geopolitical events over the years.
They certainly have. They seem to, I won't say dismiss it. I mean, if something happens traumatic on any given day, it certainly leads the news and they get the commentators on, but it doesn't seem to have, the market doesn't seem to be worried about geopolitical events. I think you're right.
I think a lot of it's the oil effect, right? Once you become energy independent, you're less dependent on, sourcing oil from overseas. Now, that doesn't mean that it won't change price. It will change price, right? Because oil is a global commodity. But it might I'll give you an example. It might become more economical to export oil and gas overseas rather than use it domestically. So, those are things that are possible to have economic effects. But we need to gauge the event, the consequences of the event, and we also need to gauge the response to the event. And they can also come, pretty quickly, and they could offset each other too. So you don't want to be reactive to these things. Because of that reason, I like to say you want to be proactive, or at least do the best you can. China and Germany are both in rough economic circumstances right now. They could certainly deport deflation. I think this is part of the reason why, despite what you're seeing in the Middle East, you're seeing commodity prices fall. Just you can look at the gas pump for a simple check. It's much cheaper than it has been in recent past. And I think the big thing that I worry about the credit markets more than anything. The credit markets have been overwhelmingly healthy, considering the rapid rise in rates that we had. And considering the commercial real estate exposure that a lot of banks would have, I think a lot of people were calling for maybe blowups and things like that. But you've seen this huge growth in private credit over the years, and I used to work in this space a little bit, so I'm familiar with it, and it makes me nervous that any kind of slowdown in the economy or slowdown in wage growth could cause air pockets in private credit. I don't worry about that from like a financial crisis point of view, but it's definitely something that I think is worth monitoring. So, those are some things that I think could disrupt the economy. But right now, seems like we're in pretty good shape.
Brian, in your comments a few minutes ago, you mentioned in passing, the House and the Senate, no one's been elected yet. But arguably, if you're thinking about what policies might come out of either president, you have to not just look at the president. People look at that, because it's one-on-one and it's, fractured, meaning people are very passionate about their candidates. But who's in the Congress, who's controlling the Congress is really something that voters really need to focus on too. Right now, the Republicans have a small majority in the House, and the Senate belongs to the Democrats just by a couple of votes. And sometimes, when people don't show up, the vice president, who's running for president, has to go into the Senate and cast a deciding vote. So, how do markets feel about who's going to win Congress, and what do you think investors prefer for a congressional outlook? Meaning,
I think the market thinks that the two most likely outcomes are split Congress or with a Democratic president or a Republican sweep. I think those are the two most likely things. Now, those are dramatically different things. So to me, it's like, you're waving a wand in the air and taking a guess. It's not really an actionable thing. I like to differentiate between events that are kind of interesting to talk about and interesting to speculate on, and things that are actually actionable. This is something that definitely falls in the former.
right.
I wouldn't put your allocation based on where you think the election outcome is going to come, because even if you were to guess the president, you might not guess Congress, and even if you guess Congress, you might not guess the president, et cetera, et cetera. And even if you were to guess both, it's probably unclear what proposed policies would become laws in the end, at the end of the day. So I think a
Certainly.
lot of people could use a refresher of their basic civics lessons and understand that, at least for now, the president isn't all powerful in this country, and can't, and vice president definitely isn't all powerful in this country. And you need some congressional help most of the time.
Yep. So whoever becomes president is going to have to deal with, I would suggest, either a divided Congress, or even if it's all in the same party, we have to remember that it takes 60 senators to move anything controversial through the Senate. So getting 60 senators, when the outcome will be within 2 or 4 at the most. If you look at the projections, the majority will be between split, equal, but no more than one party having more than 4 majorities. So, and if you believe the candidates for president, we're not going to have any tax revenue anyway, because they're not going to tax Social Security. They're not going to tax tips. They're not going to tax, some don't want to tax capital gains. And so it's crazy what they say. I mean,
Well, it's funny, you can say anything, right? Because
you can say anything,
you can
and
say anything. There's no consequence to it whatsoever.
and then you can blame Congress for not passing it after you're elected.
Yeah,
But
if it doesn't work out, you just blame the other side, right? It's American politics, at its finest.
it
So
is.
I
And
think that's a good lead-in, though, to
go ahead.
what I did want to talk about.
Sure.
We do have, an issue, which a political issue, which is gonna either sunset or be revised. And this, normally I say, let's worry about what we know for sure. And we don't. The only thing we know for sure is that if nothing happens, then the Tax Cuts and Jobs Act will revert back to what it was prior to the law going in effect in 2017.
And even if
Which,
something does happen, it could sunset, because who says this, back to my most recent point, who says there's going to be consensus to allow this to be extended?
right. So I mean, if there is a split government, for example, I think there's probably a good chance that it just sunsets.
Hmm.
But I want to get into my assumptions before we get too deep in here.
Yep.
Again, you can feel free to disagree with this. This is, to me, a lot of it is economic fact. But economics is sometimes be a moving target. To me, this is not non-political. That's my disclosure. Now, deficit spending is inflationary. Okay, it is inflationary and it is stimulative as a general rule. Now, not all deficit spending is the same. So,
Hmm.
spending on assets that provide a return generally are not inflationary, or not as inflationary, or won't be inflationary over the long term. So what do I mean by that? So if you invest $100 billion on a project which will grow GDP by a significant amount, then that might be less inflationary because you're going to make the economy more productive. Policy that benefits lower end consumers is more inflationary and more stimulative. So if you have, let's say, the CARES Act, for example, which put trillions of dollars into everybody's pocket,
Right.
Well, not everybody's, but definitely on the lower 50% of the spectrum, you're more likely to get inflation and
Sending out checks to
stimuli.
people creates inflation.
Well, I'm specifically saying on the lower end here.
Right. Okay.
Yes, I agree with you. As a general rule, again,
Yep.
deficit spending is inflationary and stimulative, but it's more stimulative and more inflationary if you do it for the lower end consumer. And why is that? Because they're more likely to spend it.
Right.
They need the money. They are going to spend it on typical goods and services. Where the higher end would more typically save it, which wouldn't necessarily be stimulative, and it definitely wouldn't be inflationary.
That's fair.
So now, in policy that benefits higher end consumers, it's the exact opposite, right? It's going to be less inflationary and less stimulative. So if you're thinking of cutting taxes for wealthier people, for example, it might be, you might like that policy, but it won't have much of an effect on the economy. It will have some, but not as much. Where if you were to give a tax cut or a benefit to lower end, it would be much more inflationary and much more stimulative at the same time. If you need any further evidence of this, I refer to you what happened after the CARES Act and the subsequent subsequent stimulative packages after that.
Sure.
We had very, very high GDP. We had very, very high real GDP, and we had very, very high inflation that we all know well. So tariffs are inflationary and depressive. So if deficit spending is inflationary and stimulative, tariffs are, there's the worst possible of both, right? They're inflationary and depressive. So both parties have been pro-tariff. I mean, there's just no doubt about it over the last two administrations, and at least one party is very vocal. Donald Trump's very vocal about increasing the trade barriers and tariffs. So generally speaking, that is a economic no-go. It has historically been an economic no-go. If you are worried about inflation in your retirement, for example, you should probably be rooting for more open markets and not necessarily for tariffs. There might be good reasons to have them. Again, that's not what this is about. This is about economic policy.
I think the biggest concern that I have with the tariffs dialogue is we're not getting a definitive answer from Harris. So I'm talking more about Trump's potential tariffs. Is he's more talking about not what he did in his first term, but he's talking about more like a broad-based tariff instead of targeted tariffs, which seems to be more in line with what I'd be agreeing with you on, that it's worrisome if they're just tariffs on everything coming in rather than specific tariffs for specific reasons, maybe to make the market fair or maybe, to protect American companies, steel, for example.
Yeah, I think that's good color. Increases in the labor force, they're the exact opposite of tariffs, right? They're disinflationary and they're stimulative. So why are they disinflationary? You have more people to choose from. Wages aren't going to be high. Inflation's not going to be high, but people are often tend to be more productive than their wages, which is why we have positive real wages. So it'll also be stimulative, and that's been the case over the last couple of years here since 2022. We've had a big influx in the prime age working population. We've seen wage growth come down, but we've also seen inflation come down quite dramatically, while GDP has continued to do very well. So, if you're thinking about immigration policy, that might be something to consider. Now, finally, and we can get into some specific stocks, bonds, high yield bonds, inflation, unemployment, general beneficiaries after this. But if a policy is stimulative, generally it's good for risk assets, unless it's so inflationary that it will cause rates to rise, because stocks are a function of earnings and interest rates. If you stimulate the economy, you might get more earnings, but you might also get higher interest rates from the form of inflation. So there's a balancing act there when I am trying to determine, when I look at these policies from each of the candidates, and I'm trying to determine which, direction. I'm not
Yep.
putting solid numbers behind this, but which direction I think each policy could push the capital markets.
And since no one is talking about deficit reduction, no one is talking about slashing the budget or having some strategic plan to, deal with our national debt or our, projections of running out of funds for Social Security and Medicare. There doesn't seem anyone to be talking about reducing government spending at all.
No, so deficits are going to go higher likely
Right.
if if either candidate gets
Either candidate.
their policy in control. The Republican side is going to increase that deficit by about 3 times. So it's not that 3 times the Harris policy, according to J.P. Morgan and according to the Congressional Budget Office. So that's something to consider. I know that we like to say that both sides are, bad at this, but in this case, one actually is significantly more, inflationary and stimulative than the other.
Well, as a Republican, lifelong Republican, I'm extremely disappointed in my party that we're not talking about the things that I just listed. They had been hallmarks of card-carrying Republicans that we were talking about. We weren't always faithful to what we were talking about, but we were, at least it was on the agenda. We were trying to move forward deficit reduction and responsible budgets, but it's disappointing that you can't find a candidate of either party, but I'm just talking about Republicans right now, that is interested in talking about it.
Yeah, I mean, we get a lot of questions about the national debt,
Hmm.
which I always find interesting, and I just throw up my hands and I say, both parties are for increasing it. So I don't
Sure.
really know
Sure.
how to respond to it sometimes, other than it hasn't been a problem yet, and it could be a problem in the future.
Right.
And that's the reality of it. So when you think about these things, right, they might be offsetting, right? So and they might and
Yep.
some might be might not be. So I'll give you an example. So like we mentioned, Harris policies, Kamala Harris's policies or proposed policies, and I got these from J.P. Morgan's election website. I'm borrowing a lot from J.P. Morgan today. They get some good stuff. I looked at each one of their corporate tax policies, their immigration policy, and their regulation policies. So the Tax Cuts and Jobs Act will, if Harris had her way, wouldn't go back to the original tax
Right.
rates, but they would go up especially for higher individuals. Now, like we said, taxes going up, that's actually, that should help the deficit situation. Of course, that money's going to get reallocated somewhere else. So, in the end, her policies are deficit plus. But, she does, for all intents and purposes, is going to raise taxes from the current level, not
Yep.
back to the prior level. Now, if you think about that from a stock perspective, it should mean that stocks would go lower in general, right?
Right. Yep.
But she also sees things like a benefit in the child tax credit. Like I said, this isn't all; it all gets reallocated, right? So a higher child tax credit would mean a more positive effect on stocks. So I would say this is negative to stocks to unchanged. There are some positives since it's going to get reallocated elsewhere to tax benefits, but it's probably a net negative because it is expected to raise revenue for the federal government. Both basically anywhere you look, the increase in taxes will do that, particularly because it's coming from corporate taxes, which means if you're raising the corporate tax rate, you're lowering earnings, which should
Hmm.
be a net negative on stocks. So I do think this should be a negative on stocks, except for the fact that if you raise tax revenue, it should be positive for the Treasury, which means that you would have a net lower rates. So you might get a little bit offset there too. So it might have a more positive effect on interest rates, a negative effect on earnings. Altogether, I think that you would see PE ratios stay similar, or PE ratios might even rise under the situation if rates were to come down, but the E would go lower. So it's tough to determine, and I would just call it undefined at this point when you marry the earnings and interest rates expected under that Tax and Cuts and Jobs Act from the Harris administration. Now, if you look at it from the Trump administration, I would say that stocks would probably be higher because he's trying to cut taxes everywhere.
Right.
So, I believe he's even trying to lower taxes further from where they are now. So that would probably be great for the earnings side of things. On the negative side of things, it would be, we're looking at significant amounts of deficits, which means higher treasury rates, which means you might get a slight offset. So, it's kind of the mirror image from what you're expecting from the Harris. But on the net, I think it would probably be more positive for stocks.
Brian, we only have a couple minutes here left in our projected time for our show today. Give some commentary of your thoughts about after the election, assuming we have it's a whole different show. If we don't have a settled election, we'll just put that to the side. But if we have a settled election and the results are what they are, does the market have a possibility of having like a sigh, a breath of fresh air, having this behind them? Companies know who's in Congress, who's in the White House. Does some of this worry that we talked about earlier in the show and this hesitation of investors to believe in the bull market, does some of that dissipate no matter who wins, no matter what the makeup as Congress is? Is there like a relief rally or something, a relief for the market now that they know who's in charge in Washington?
I think so. I'm completely speculating on that, and again,
Sure, of
that's something
course
that's
we
fun to
are.
talk
Yep.
about and not
Yep.
necessarily actionable.
Yep.
But I think so. I think we've seen a dramatic slowdown in hiring recently, which I think is interesting, and I think it's people being careful. I think there's a lot of tension around this election, and people rather hold back their pocketbook, particularly around hiring right now until after the election. So I think you might just see a flutter of activity from people who were nervous and,
Right.
say, hey, look, it's settled. Let's hope that it gets settled, right? I mean, this wasn't settled, on January 6th of last year, and
Right.
so not last year, 4 years ago.
Yep.
So, let's just hope for that outcome that we have, a clear-cut winner after. I don't think it's going to happen on election night, but after a few nights of counting some votes.
Brian, thanks for spending time with us today and giving your thoughts. And if you're a listener and you're on the blue team, if you're on the red team, if you don't have any team at all, just make sure you get out and vote. Your vote matters, even if you're in a state that it doesn't seem to matter. You're in a state that's Republican or Democrat. You got races for the U.S. Senate, the House, and all your local races. Get out there and vote. And whatever you do, don't make decisions based on politics or emotions. Make them, hopefully, with the help of a good financial advisor, someone who has your best interest at heart. And keep listening to the show, Something More with Chris Boyd. I'm sure Chris will be back next week. Until then, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com.